The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. He's as old as the Tomago aluminium smelter, but he doesn't need propping up. It's Anthony Macdonald. How are you, Anthony?
Still kicking, like Tomago. Hopefully for another 10 years plus, James.
At least. Well, this week we turn the housing market story on its head, we unpick an eventful afternoon at the Reserve Bank of Australia, and we pull out our most surprising tidbits from reporting season's big first week.
Let's start where the action is on Friday though, James, and that's Canberra Parliament House, and some corporate heavyweights are getting grilled by politicians over the KPMG affair. Remember, KPMG was caught using a client's confidential information to try to win over some other clients. We had Westpac Audit Committee Chair Michael Ullmer, Dexus Chair Warwick Negus, Macquarie Chair Glenn Stevens, the former RBA Governor, Optus Chair John Arthur, all before the morning tea break on Friday, James. There was lots of trust talk, as you'd expect. This is about audits and trust. How did the big dogs go? And did we learn anything new?
Oh, we learnt that KPMG's troubles are only getting bigger, I think, Anthony. My takeaway is this was very clever by the parliamentary committee that's, really been crusading against KPMG over this affair. What they've done is essentially forced some of the biggest names in corporate Australia. I mean, you mentioned them there, Westpac, Macquarie, Dexus, Optus. They've forced them to come and basically say, yeah, we're not sure if we can trust KPMG anymore. I mean, that is brutal because think about the consequences of it. Who in their right mind is going to appoint KPMG as an auditor in the next, 3 years? Now, yes, there's only 4 auditors in town that can handle the sort of those big complex jobs, and KPMG is one of them. So maybe that gives them a fighting chance. But I think what this parliamentary committee is basically saying to corporate Australia is hire KPMG at your peril. We don't trust them and we don't think you should either. And those firms that hire them, we're going to be asking questions of you. That's a pretty big starting place. So I guess the other point, Anthony, geez, corporate Australia is a small world, isn't it?
Sure is.
Everybody knows each other. People play golf and have sleepovers at each other's house, literally. So I think this has gone a little bit of a way to exposing the sort of clubby nature of corporate Australia, which we all know is there, right, Anthony? But it's interesting to see it laid out in front of a parliamentary committee.
Sure was, James. I mean, that smallness of it all, if you look at Michael Ullmer, he was up first. He's the Westpac Audit Committee Chair. But he was also Lendlease Chairman at the time all this was going down as well. And you remember, Lendlease is the one whose information was sort of used first here when this all started. He's also a former KPMG partner back in the day, James. So, he gets appointed to the Westpac board because he's Lendlease's chairman and a former KPMG partner. Then Westpac starts using KPMG and, nothing against Michael Ullmer. He's a man of great repute in corporate Australia. But it just shows how, you have one person getting sandwiched on all sides of this. It just shows, to your point, how small corporate Australia is. And in some ways, that's good. I mean, you want the exceptional people to rise to the top and be able to wear as many hats as they can. But I mean, it also looks quite ridiculous when you see them roll into a Senate inquiry on a Friday morning in Canberra, and you just hear about things like sleepovers and stuff. that one was a cracker. I mean, we expect golf games, but sleepovers, that's next level.
Yeah, absolutely. Well, the hearing's continuing as we record on Friday morning, so check afr.com and, of course, the weekend paper, the AFR Weekend, for full coverage. It's a huge day for KPMG, and I think it's a big day for corporate Australia, so our team will be all over it. Anthony, let's move on to some other stuff, and the deals are back. In just a few days, we got a $9.4 billion bid for Cleanaway, whose garbage trucks pick up more rubbish than anyone else in Australia. We got $1 billion bids for a billboard company called Media and a car leasing company called Fleet Partners. And then Tabcorp, which runs the Tab in Australia, it bought a software company called BetMakers. Anthony, we've had a bit of a funny year for deals, but all of a sudden, it's all happening. Is something in the water at the moment?
Yeah, there's a few things in the water, James. So first of all, I mean, it's the time of year. If you want to get something done this year, or want to, make a big impression this year, I mean, it's the 14th of August today. You've really got to get cracking.
Get moving.
Sign that deal. Get it signed, because, it's going to take a few months or more to complete and get through regulatory approvals. If you want to kickstart the new year with a spring in your step, you really got to be moving now. I mean, the uncertainty earlier in the year, Iran, oil shock, the big shift in the rate cycle with 3 rate rises, it was hard to move when there's that uncertainty sort of going around. Now, I mean, those issues still bubble away in the background, but people are sort of more comfortable with them. So there was a bit of a backlog of deals. I'd say the fact that we got those 4 listed ones you're talking about happened so close together shows that some of that backlog's released. The structure of the ASX, talk about this all the time, but the changing equity market structure, the way that index and index adjacent funds, the performance tests, big super is bidding up the top 10 stocks. And it's the same at the small end of the market. The top of the sort of small caps index gets bid as well. I mean, it leaves a lot of overlooked stocks that are sort of cut off from a growth funding perspective that don't really get much investor attention, and they're trading pretty cheap. So, I mean, if you look at those 4 deals that you mentioned there, none of them are high-flying sorts of things getting picked off for massive prices. They're all sort of limping along. The last thing, I mean, it's reporting season, and it's kind of weird that you get these bids during reporting season. Normally, bidders wait until after results. Like, normally you'd wait and see the numbers come out and then launch a bid. But I think it shows just how long talks have been going on for some of these.
Yes.
When they announce their deals in the paperwork, you can actually see when they started their confidential talks. And in that Tabcorp BetMakers deal, they started confidential talks back in October last year. Right. And it's now August. So it's taken 10 months to get to this. And that means that deal had a lot to survive. It survived everything from the Iran war, budget, 3 rate rises, Kyle and Jackie O breaking up, Tay-Tay's wedding, Barnaby yelling at the dog, all that. So certainly a lot of deal action this week.
Just tell me a little bit about Cleanaway. You mentioned before, most people would know this, the Cleanaway logo scrawled on bins around the country. Lots of people would have their rubbish picked up every week outside their house by a Cleanaway truck. It's a big, proper listed company. It's been listed since 2005. It's a big employer. It's got a big asset base, a big network. So who's coming in and buying this, and are they going to get this without a fight? Surely this is a set of assets that lots of people would want.
Yeah, it's a private equity firm called EQT, big global firm, one of the biggest in the world. I mean, they're out of Europe and Sweden to start with, but they're now global. I mean, they're like a KKR or a Blackstone, James, in that sort of top echelon of private equity. Yep. They're buying it via their infrastructure arm. I mean, is it an infrastructure asset? I mean, there's some infrastructure properties there, but I'd still think of it as a private equity deal. I mean, private equity is really using this infrastructure tag well, and it's raising lots of money for them. But I mean, I don't think it means we have to all think of these things as infrastructure deals. I mean, for me, the timing of this one's really disappointing for Cleanaway shareholders. The company's been through a lot. Like, it's been a very eventful 20 years on the ASX. It nearly went broke in the GFC, bought big assets, sold big assets, lost a CEO unexpectedly. The most recent chapter's kind of been 5 years of stability. Mark Schubert, the new CEO, has been trying to tidy it up a bit, grow the business. Yep. He's bought quite a few things and sort of just kept buying and reinvested a lot in the business. I mean, it is a business that requires a lot of capital. So a lot of money's gone into the business for future growth. And before that growth has sort of turned up in the earnings, private equity's turned up with the bid and pounce. So, I mean, the headline multiple, private equity is offering 20 times earnings, which is good. Problem is that earnings number, I would say it's a bit disappointing given all the capital that's been invested in the business and what the believers think the outlook of the business should be. But private equity is opportunistic. There's some agitated shareholders at Cleanaway. Some of the believers who this time last year, I'd say they wouldn't have sold the company. I mean, they sold out sort of in the past 6 months. The board's recommended that EQT bid before it's even gone binding. So, I don't know. I mean, will there be a fight? There's tension there, but I'm just not sure there's going to be enough big shareholders pushing back. Because part of this whole thing at the market at the moment, James, if you offer people a 30% premium, most of the time they're going to bite your hand off.
Yeah, yep.
And Cleanaway, there's probably enough new investors on the register who haven't ridden the ups and downs of it, who bought in more recently because it was cheap, that they'd probably sell out.
Yeah, all right. Well, we'll watch it. Hopefully we get a bit of a takeover brawl there. That's what we love most.
Now, James, the big story in Super this week is Australian Super's efforts to get more into financial advice. Australian Super, the country's biggest super fund with 3.6 million members, will start rolling out automated personal advice for members in coming weeks, notionally in a bid to have them better prepared for retirement when that time comes. James, do you think this is the solution that Australia's great unadvised problem has been waiting for? Or is it just the next chapter in the other persistent problem, conflicted advice?
I think we have to accept that all advice is conflicted to some extent, and it's how those conflicts are managed and how they're disclosed that it's important. I think we need to look at the bigger question here. As I've said a few times on the podcast, I sat through all the hearings of the Royal Commission, and a lot of it was about this idea of conflicted advice. And we came out of that Royal Commission with a lot of measures to stop conflicted advice. Unfortunately, what happened is we, chopped the number of advisors in half.
Yeah.
And now there's lots of people who are unadvised. And what they're doing is turning now, increasingly, not to their own research, but to ChatGPT and other forms of AI. So we've got this problem of more people retiring with much bigger pools of wealth, thanks to rising house prices and rising super balances. But they don't quite know what to do with it. They don't know how to make it last throughout the rest of their lives post-retirement. They don't know whether it will last for the remainder of their lives. So people need advice. They need help. I think superannuation funds need to get involved in that. Super funds have been great at what's called the accumulation phase, where they collect lots of funds and build up people's savings, but they also need to get much better at the deaccumulation phase, when people get to spend the money that they've saved for their retirement. So I think this is a thorny problem that's going to need lots of solutions. Some sort of automated personal advice. It's probably going to be pretty general in nature, let's face it, if it's automated. That's not a bad starting place. But, the government has been going slow on reforms around advice for too long. And so I think it's good that Australian Super's doing something about it. We're going to need lots of different approaches to this, I think, Anthony. You're still hearing these stories out there of retirees putting their life savings into some, dodgy fund, facing another life crisis that feels to me to be completely avoidable, with even a skerrick of reasonable advice. Doesn't have to be perfect, detailed advice. So we need to get onto this before it becomes a much bigger problem.
Yeah, we've got a wave of retirees coming, James. 2.5 million in the next 10 years.
Yeah.
That's a huge number, right? And as much as you or I need financial advice, the time you really need it is that sort of switch to retirement, where your whole investment strategy might change. You've got to think about the pension and how everything fits together. So this problem's been brewing, like you said. I mean, super is one way to fix it, because, retirees and nearly all going to have super accounts, right? They've at least got a relationship with this super fund. I mean, the other way that you could fix it is via the banks, and the wheels fell off that through the Royal Commission, like you said, with the whole vertical integration. But, super funds have been told they have to get their retirement products ready, and that's making them think about doing advice as well, because they think you need both. I mean, the banks are also thinking about this exact same problem and thinking about how they can get back into this sort of sector as those retirees are coming. So I kind of wonder whether we're on a collision course here between the super funds and the banks over financial advice and retirees and retirement savings. Again, James, because these are the two big forces that we talk about every week, right? The banks and the super funds. They've sort of been great at keeping out of each other's hair. But I just wonder whether they're both sort of moving at this problem at different paces and in different ways, but they both sort of see an opportunity there, and they both sort of want a piece of it.
Great. Let them collide, because that will mean more advice for more people and competition to provide better advice. Let the collision occur. Please, everyone get involved. Under the right set of circumstances and the right set of rules, that's fine. My concern is not so much about who gets this pie, but the fact that we need to be able to serve this big client base. I spoke to this guy a couple of weeks ago, an American called Soraya Kaluri from the TIAA Institute in the US. They're all about sort of research about retirement and annuities, income, what products work best. He made the point that we're now seeing a lot more people live to the age of 100. Now, that is something that when the superannuation industry started was not really a realistic prospect. It now is. So this super issue is becoming bigger and bigger. We need to get on top of it with as much advice as possible, I reckon.
Good point.
All right, Anthony, let's move to our first topic, which is an oldie but a goodie, and it ran through a lot of what we were writing and talking about this week, and that's, of course, housing and the sell-off in Australian house prices, which might be a step in the right direction or the wrong direction for the country. We've got some great contributions in the debate this week from the Westpac and RBA Governor Michelle Bullock, which we'll get to in a bit, but it was Commonwealth Bank CEO Matt Comyn who stole the show. Despite revealing a 15% drop in mortgage applications since the budget in May, which scrap negative gearing and CGT tax concessions on the purchases of existing homes. And despite running a bank that makes money from home loans, Commons said he has no regrets about what's happening in the housing market. And we need to wake up to how out of whack the economy is and think about the benefits of stopping the runaway housing train before it's too late. Anthony, we spoke to Common on Wednesday and he was pretty thoughtful on this. Why does he say everyone needs to calm down about a few months of house price falls?
There's a few things. He says, first of all, remember the problem we're trying to solve here. Housing affordability, intergenerational equality. I mean, the taxes were specifically designed to take some of the heat out of those house prices to stop them running away even more from genuine home buyers, right? People that are buying to live somewhere. It's worked. You got the housing price index from Cotality. That index fell 0.7% last month, biggest drop since December 2022. Led by Sydney and Melbourne. Nationally, I think the index is down 1.9% in the past quarter, which is pretty much the budget timeframe. So it is taking some of the heat out of the price increases and even leading to some decreases. But he says, we're also trying to tinker with the tax base here, which is a longer term sort of issue. Tax capital assets more as the population ages, reduces reliance on income tax. That was the perhaps most disappointing part about the budget and the changes.
Yeah.
But just say it's sort of headed in that direction. And in Matt Common's mind, I mean, the other thing we're trying to solve here, and you don't hear the government talk about this, is shifting our mindset or society's norm about where you should put your investment capital. We have trillions of dollars, literally trillions, locked up in housing, both in our own housing and in housing as investment. I think he said, 57% of the average Australian's household's assets is their home that they're living. I mean, that capital is just sitting in the ground. That's in the bricks, and it's been a fantastic investment over the years, tax-free, 8 or 9% gains for a generation or more here, James. Absolute game changer if you've got one. But while that capital sits in the bricks, it's not being used elsewhere. And just imagine if that capital was available elsewhere in the economy. I mean, it could be used by business to build new factories or grow or invest in new tech platforms or whatever, which grows the overall economy, can fuel productivity growth, can help everyone get wealthier at the same time rather than just the homeowners getting rich as they trade houses at ever higher prices amongst themselves.
Yeah.
We talk about this stuff all the time on the pod, James, but I think he just said, just keep your eye on the goal, basically, and don't freak out. He also said, the housing sell-off hasn't been as dramatic as people are making out. The actual prices haven't dropped that much. I mean, we've seen greater sell-offs at different times in the past decade alone. So just take a chill pill, which I think was a general message.
I think that's right.
Yeah, you pointed out another good chart in CBA's results pack. It showed Australia's population growth is, and for a while will be, running well ahead of new housing growth. I mean, do you think that's also part of Common's message here?
I think that's part of it. I mean, he's saying, calm down, these house price falls aren't that big, but also calm down because they probably won't last that long because the underlying demand for housing is still very, very strong and the supply is still weak. We are just not getting enough houses out of the ground. He had some great numbers from the Productivity Commission's recent look at housing. Over the last 30 years, productivity in house buildings halved, basically. So, it's taking a lot more time, effort, resources, money to build the same number of houses. I mean, that's crazy. We're a developed and developing economy, I think. But this is the thing that Common's trying to get to. It's not a good thing for the country that housing credit growth, that home loan growth is running along at 7.5% a year. That says we're misallocating capital. We're not putting capital into supporting businesses, supporting investment, supporting jobs, supporting the next wave of changes or improvements in the economy that underpin living standards. What we're doing is, as you said, just flogging houses to each other. What are our economic priorities here? It's not housing. Being rich is one thing, but it's living standards that's important over the long term, and that needs the productive capacity of the economy to grow.
Yeah, of course, Matt, he was speaking only one day after the RBA's board decision, James, on Tuesday. It kept rates on hold, but a hold's never just a hold, is it?
No.
Do you think Michelle Bullock, does she come out talking tough on rates, or do you think the board's done and the next move's going to be down?
I don't know. And honestly, I think if you take what Michelle Bullock said at face value, she doesn't know either. They think interest rates are restrictive at the moment and they're going to slow the economy enough to bring inflation back down to the target band of 2 to 3%. Okay, but then Michelle Bullock made it very clear that the risks on that are skewed to the upside. It might be that the Iran war lifts energy costs and pushes inflation higher. It might be that this data center boom we're having, squeezes costs higher in lots of areas as well, and that adds to inflation. So the risks are still very much skewed to the upside, as Bullock said repeatedly on Tuesday. That's the concern. But Anthony, you know what I kept thinking about this week?
Yeah.
All right, let's say we slow the economy enough to get inflation down this time. By 2027, late 2027, we've slowed the economy enough, unemployment's risen enough, and inflation's down enough that we can start cutting rates. Hey, that's great. But if we don't do anything to fix the productivity problem in this country, we're going to be back in this exact same problem almost instantly because the speed limit of the economy is so low. We just can't grow much more than, probably about 2% without inflaming inflation again. So yes, this current inflation problem deserves lots of attention and will continue to get it. But I'm worrying about the next one now. If we don't see that change in the allocation of resources in the economy that Matt Common's talking about, we're just going to keep having this same problem again and again and again. That is why something needs to shift. And I think Matt Common has articulated that really well. I think that's what Michelle Bullock is hinting at when she talks about productivity. Is that message getting through? It's hard. We're all worrying about Barnaby's dog or Albo's crap joke about melons. We're all worried about the here and now, but we're not seeing this big problem that is going to keep building. Anyway, we also had results from Westpac and ANZ this week, and they're big housing market players too. Do you think they're on Common's Team Australia calm down about housing cohort?
I thought Westpac had some pretty meaningful numbers they put out there. They said mortgage applications had dropped 20% or so in the past quarter and a half, post the budget. The impact of the rate rises basically in tipping 4.7% housing credit growth next financial year, 5.2% the year after that. That 4.7%, that number, that housing credit growth number has sort of become a really topical number after the budget, after the interest rate rises. There's a big debate between the banks and investors and analysts about whether that 4.7% is realistic or not. Like you said, that's those 6-7% housing credit growth days are behind us. But what's the new norm? I think the markets kind of think it's like 3.5%. But Westpac's saying 4.7%. I think on the analyst call, Matt Common was saying 4 to 5, closer to 5. Feels about right. So it feels like he's sort of, seeing the same thing through his book. So, that's a bit of a Team Australia message there. I think that the housing market's okay, no need to freak out because of the changes. There was only a quarterly from Westpac and ANZ, so we didn't really get to grill the CEOs that much on this stuff. ANZ's numbers, it's a bit of a different sort of bank, more institutional, more offshore payments and stuff.
True.
Its mortgage application value was flat. I think it said for the quarter, down about 12% post-budget. Not as bad. It wants to grow in line with the system. But I think if you had to rank all the Team Australia players at the moment, James, I think Common's up there. He said a few times what's good for Australia is good for CBA.
Yep.
Which I guess gives him license to be on Team Australia and still front shareholders and saying he's doing the right thing. Because, at the end of the day, Australian Bank, they're all in on the economy, the housing market, the jobs market.
Totally.
The other one you hear talk like that is Australian Super, which, like we said, it has 3.6 million members. You hear them say what's good for Australia is good for members. So I'd say the two captains of Team Australia at the moment would be Matt Common and Paul Schroeder at Australian Super, the boss over there. And they're both saying similar things at the moment. Too much capital locked up in unproductive housing assets. Let it flow. But I came away from Michelle Bullock's appearance on Tuesday, James, actually thinking, how do we get out of this mess? Because if people listen to Matt Common and business invests more in the short term, it's going to see everything take off again, right?
Yeah.
So I went into reporting season saying I want to look for signs of business investing and growing and trying to boost his productivity and all that sort of stuff. But Michelle Bullock's actually saying that, hang on, we need to actually keep the brakes on for a while. We actually need economic growth to be at 1.3, 1.5%, for 12 months or so. We need unemployment to get to 4.8%. Just to cool everything off to really stamp out the inflation.
True, yeah.
So in my mind, I'm kind of wondering how quickly can we get through this low growth patch to kill off the inflation before then we can get on with the rest? Or can we actually start transitioning to the next leg now?
I think we can, if those investments are in productive assets that lift productivity growth. That'll help Michelle Bullock. So yeah, I think you're right, Anthony. Either way, we got a couple of years of pain as we get through this period. But let's not waste a crisis. Let's start investing now in the next set of productivity enhancing measures so we don't have this problem repeating again and again and again. That's what Matt Common's thinking about. He's not thinking about what CBA's earnings are going to do in the next 12 months. He's looking, I reckon, 10 years down the track, 20 years down the track, when he'll be long gone. But he's thinking, how's CBA going to grow then if the economy is sort of stuck in the slow lane?
Problem is, though, Michelle Bullock says building things is really expensive. And I know that investment isn't just building things, but it can be a big part of it, right? Construction costs are really expensive. And she says at the moment, the construction costs on new housing makes it really hard to justify building a house to sell it because you might not recover what you're investing in it. At the same time, data centers are coming in for their big construction. They're bumping up construction costs too. So then if we have all this like CapEx type construction outside of the data center sector, it's just what's going to happen to construction costs.
True, but this is where you need productivity changes to bring down the cost of building. Commonwealth Bank had a few suggestions: more modular building, faster approvals that mean you're not holding onto land and you're not delaying the projects. And so that helps bring the costs down. So we can and we need to be able to walk and talk at the same time, but it just doesn't feel like we're managing it at the moment.
Yeah, so maybe instead of our two-man lobby on business get spending, we needed a two-man lobby on the government to clear all the red tape first.
Hey, we need to do all this stuff all at the same time. I mean, we need both sides, business and government, pulling in the same direction at the same time. Common was sort of saying we had the tax changes that helped, address some of those intergenerational issues, but we didn't get the incentives to stimulate investment. And that's the missing piece. Over to you, Albo. Forget the melons. Let's get on with it.
Okay, James, it wasn't just CBA's result this week. We got hit with an absolute avalanche of earnings numbers from CBA,
Sure,
Telstra, Origin, AGL, Transurban, Insurance Australia Group, Treasury One Estates, Westpac, ANZ, ASX, and more. Not sure about you, James, but I thought it all peaked on Thursday when we got hit with 4 seasons in one day. Winter, football season, cricket season, earnings season. It was a battle to keep up.
It sure was.
I still don't know the closing score in the cricket on day one of the test. Now, we'll get into the quirky bits in a second, but can you step back a bit for us and tell us, is there any trend you've picked up from reporting season to date that listeners should know about?
I reckon there's a couple. Everybody's talking about data centres. Whether you're SGH, the big building materials company, they want to get in on data centres. Origin Energy and AGL Energy both reported. They're all about the boost to data centres. So I think everybody's thinking about how this big data centre build-out can drive economic growth, and more importantly, how can they get a slice of it? The other big theme for me, Anthony, I talked last week on the podcast about the Great Australian Squeeze, as we see companies pushing through price hikes and cutting costs at the same time, sometimes cutting jobs. I think that's what we saw that. We're seeing that everywhere. Telstra, the insurers, they're all trying to push through price hikes because they're facing inflation inside their businesses. And then they're also trying to cut costs because they're not getting much of a tailwind from a sluggish economy. So I think the Great Australian Squeeze, it's absolutely on. What about you, Anthony? What sort of big trends did you see?
Balance sheet's pretty strong out there, James. I mean, the companies are in pretty healthy positions. I mean, they've got enough for dividends. There's been a little bit of capital management, but, it's quite strong. So while they're paying their dividends, I mean, shareholders love their dividends. I mean, most big listed companies don't really have a choice on that. And those dividends are probably in line with prior years, but they're not returning all of their capital, which makes me wonder, what are they saving it for?
Yeah.
Origin's a good example. Net debt to EBITDA 1.6 times. The amount of debt it has is 1.6 times what it earns in a year. That's down from 1.7 times last year. That's a good move. If you're a shareholder, you like that. But that's below its target range. And it's been below its target range for 5 years now. So basically, Origin is holding on to more cash than the board says it normally would target. It declared a 30 cents a share dividend for the second half, 60 cents for the full year, same as last year, even though it had the capacity to pay more. So I said to Frank Calabria, the CEO, What are you waiting for here, Frank? And he gave a pretty straight down the line answer. I mean, at the moment, we've got the energy transition, there's investment opportunities. If we don't have a better use, we will return it to shareholders, but we're looking at things. I mean, there was nothing specific there. So for me, that's like a optionality sort of value that he's sitting on. And I guess shareholders aren't really pushing them yet to give it back. But, as I said before, went into this reporting season looking for signs of business investing. I mean, we have the conditions right. Business is sitting on strong balance sheets mostly. I mean, capital markets are open for funding if they want to use them. But Origin's obviously waiting to pull the trigger on something. Commonwealth Bank, like Matt Commons said, he's been using his excess capital to ramp up business banking loans. So he wants to lend money to Origin if they want to do something with it. But, they're just not jumping yet. I mean, likewise, AGL Energy, it's well inside its covenants, yet it's sort of tightened its dividend outlook, telling shareholders it's not going to get over its skis on dividends this year. So, I'm just sort of watching that sort of growth versus shareholder returns pretty closely.
Yeah, good call.
Now, James, every day in earnings season, we do a reporting season wrap. It's a column. We call it What We Learn. It's a fun exercise looking for little bits and pieces of interesting information. And let's try and do the same here on the pod. Can you tell us, James, something that's a bit off the beaten track that caught your eye this week?
I've taken a little line out of your playbook, Anthony. I know you love looking at the car market.
I love the car market.
The nation's car park, as Steve Johnson, the head of Suncorp, described it to me this week. And the nation's car park is changing. You can see it out in the roads, and you can certainly see it in the sales figures. We're obviously seeing a lot more EVs sold and a lot more Chinese EVs sold. This is a global story right around the world. China is really taking over the global car market. There's a flood of new brands, some pretty cheap cars out there, actually, that seem to be pretty good technology, pretty good quality, or certainly improving quality. But that's creating a bit of a problem for the nation's insurers, because while these Chinese brands can get cars to Australia, they are struggling to get the spare parts that insurers need to do a repair when there's a crash. And so what we're seeing is that this is leading to very long delays when there is an accident involving one of these new Chinese brand EVs. And those delays create lots of other problems. The repair gets more expensive, basically, and then everybody wears a little bit of that in rising insurance premiums. So insurance inflation's running at about 6% at the moment, and the message I took from Steve Johnson is it is not coming down anytime soon. That issue in the car insurance market's one thing, but on the home and contents insurance market, repairs are just, again, becoming more expensive because we've got a shortage of trades in Australia. And Johnson says that is going to be exacerbated by the Olympics in Brisbane, which is going to suck up a lot of trades as they build infrastructure and buildings and all the stuff they need for the games. So, Anthony, don't expect your insurance premiums to be falling anytime soon. What did you spot out there?
Well, just before I get to that, James, are you telling me that EVs aren't driving themselves? Because I thought Elon's been telling us that Tesla's got all this automated driving stuff now.
Oh, yeah.
And avoiding crashes,
You keep waiting, mate. Well, the problem is the EVs are bloody expensive to repair. It's not just the spare parts. There's a lot of technology in these cars now. And so, it's not as simple as sort of beating a panel and making it look good. There's a lot of tech in every bumper and every panel.
Yeah, good one. All right. Well, just on the EVs trend, you'll be happy to know that Car Group CEO William Elliott says the secondary market for EVs is pumping.
Oh,
now.
Okay. Right.
Yeah, he reckons they're selling well.
Okay.
After it's been a slog for 5 or 10 years, but people are now comfortable, apparently, buying secondhand EVs. I don't know anyone that's done it yet, but it must be happening.
There you go.
What I've picked up on, James, this is a bit of a vibe one.
Yes.
And it's skepticism about other companies' AI claims.
Ooh, AI bitchiness.
Yeah, I don't know if you've noticed this on any of your interactions, James, but the few times that I have dared to write up a company's AI claims,
right?
The next day you get a CEO kind of like make a joke about it or snigger about it, right?
Yeah, right.
As if they're sort of quite skeptical about that other company's AI use cases, its tech spending claims or its benefits, which makes me wonder whether this AI thing, it's not a joke, but it's a bit of a joke, or if CEOs know how much the numbers and the presentations and the investors can be sort of manipulated and how much of an experiment the whole thing is. Like there's cynicism there, which is good. It's healthy. We're chock full of it. That's our job. But we're getting it from people who are overseeing their own AI investment programs. And I think it probably just shows that there's so much uncertainty there. I mean, you tell us this all the time about what the AI is actually going to do, whether it's going to be useful. Even a few years after generative AI bursts onto the scene, people still don't really know. And I get the impression that some CEOs think that others are just making it up as they go along.
And I think there is almost no evidence of AI cost savings at the moment. It's still a cost. There's some CEOs are sort of saying, I think we're getting a good deal. We're certainly getting some better customer service out of it, but no one's been able to cut costs yet due to AI. It's just not happening yet, so let's see where it goes, I guess. All right, Anthony, we'll come back after the break. Here's the next bit of data that's going to keep Michelle Bullock and the RBA up at night. Back in a sec. Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, reporting season rolls on. We got BlueScope and NAB on Monday. We got BHP and Cochlear on Tuesday, Santos and Stockland on Wednesday, Goodman Group, Medibank and Fortescue on Thursday, and our old friends, the Burrito Slingers, GYG on Friday. What are you looking forward to most out of that list?
GYG for lunch next Friday.
Absolutely.
That list, Cochlear. Cochlear had a stinker, in the past 6 months, and an earnings downgrade that just sort of was quite unexpected. We still never really got to the bottom of. Shares have bounced back a little bit, but I think there'll be quite a bit of interest in its results to see whether CEO Dig Howitt's feeling a bit better about the world.
Yeah, I'm looking forward to BHP, the first result for Brandon Craig, the new CEO, and I'm hoping there's a bit of a sign of what the Brandon Craig era might actually look like. On Wednesday, Andrew Hauser, the Deputy Governor of the RBA, has a fireside chat up in Brisbane. Interest rates and property will be a hot topic there. And on Thursday, hello Michelle Bullock, the unemployment rate will be out. It was at 4.4% last month. Economists think it could creep up to 4.5%, Anthony. And while that would be not great news for the economy, it'd actually probably be good news for the RBA in a strange way.
Yeah, you're right. She said very explicitly, just watch for that unemployment rate to slowly creep up, and that's kind of what's needed to take some of the heat out of the economy. Yes, great when everyone has jobs. She wants to see everyone have jobs, but it's all a bit tight at the moment.
Yeah. All right, Anthony, we love questions here on the Chanticleer podcast. This week our question is from long-time listener, first-time caller, Han from Sydney. If you've got a question you want to send in, you can email us at chanticleer@afr.com. We love it when you send us an audio question. Just record a voice memo on your phone, include your name and where you're from, and email it to us. Or you can always submit a question via the widget at the bottom of all our Chanticleer articles at afr.com. And thanks to Han for sending in a voice question.
Hi, Chooks. Han from Sydney here. My question relates to the 296 data centres currently listed in Australia. Data centres are required to provide their own power and water. Considering Australia's unsuccessful history in auditing by the Big Four, who is going to audit and monitor this so that the centres are not drawing power from the grid, driving up prices for the taxpayer, and drawing water from our finite water supply?
Anthony, this is a really good point from Han. How are we going to keep track of all these data centre projects? Is there a central record for all these projects, or is it all going to be done on a state-by-state basis? How's the government going to make sure that these data centre operators live up to the government's expectations around power? I mean, it's actually quite an interesting idea.
Yeah, it is. I mean, I love the cynicism about auditors and very, very topical at the moment.
Are you offended by that?
No, I love it. I think it's good. Yeah, I wouldn't be looking at the auditors, though. That's not really their role in this. Auditors are more about the numbers flowing through the financial statements and the accounting side of things rather than the business practices. I mean, the way we're looking at data centers is sort of on connection. Like there's a heap of upfront work on connection with the transmission companies that are still sort of largely state-backed to get their sort of approvals at the time. And at that time, they've got to go through where the power's going to come from, how their transmission's going to work and all that. And then they're expected to stick to it once they're actually up and running. To be honest, I'm not sure how they check it after that. We write about all the new ones that are sort of coming up, and all the focus on them is locking in all this power stuff up front. But then I'm not sure how it's monitored. It's a great question.
In all seriousness, what we probably need is some sort of register so we can all see where these are. I wonder if the energy regulator might take that on and sort of keep a running total of where these guys are with their energy demands and their energy promises on power supply, renewable energy, etc. I think Han's right. Let's get a bit of a register going so we can all see where the data centres are going to be around the country, what locations they're going to be, and how they're living up to their obligations. This is going to be the major driver of the economy for a little while, and let's keep our eyes on it. All right, Anthony, thanks for another big week, and can't wait to dive into some really juicy profit reports next week. We're going to get a really good sense of how most of the economy is tracking, I think.
Absolutely, James. It's been an enjoyable week this week, delving into the numbers, and it's only really just started, so 2 more weeks to go.
Absolutely. Thanks, everyone, for listening. Can't wait to bring you some more of the insights from that big profit reporting season next week. We'll see you then. If you like the podcast, share it with a friend. And if you want to read more about what we've talked about today, check out the links in the show notes. And don't forget, you can listen to this and all AFR podcasts on the AFR app. At the Financial Review, we investigate the big stories about markets, business and power. You can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin, our theme is by Alex Gow, and the head of premium content is Fiona Buffini.
The Australian Financial Review.